General Motors just announced one of the wildest buyback programs that I have ever seen. The company's going to buy back about 17% of its stock by the end of this week. Yes, 2 days from now. They're going to send $10 billion to a series of banks, and $6.8 billion of that is going to be immediately turned into stock that they're going and $6.8 billion of that is immediately going to be redeemed for stock. Now, General Motors is a company that I think a lot of investors overlook. The auto business is very difficult. We're transitioning to electric vehicles, something that General Motors has pulled back on. The cruise business, which I think has a lot of upside eventually, is currently off the roads after a number of safety incidents. So there's a lot of uncertainty surrounding this company, but with recently reintroduced guidance, shares are only trading for 4 or 5 times earnings. And this buyback program is buying back the stock at that insanely cheap price. And I think GM is the kind of company that can keep cash flow growing, keep margins very high. And that's why this is going to be a great stock long term, despite the fact that it is not leading the electric vehicle future. So I'm going to get into some of the details of what was announced today, both with the buyback and with the update to guidance, and give a little look at what to think about this company long term. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to thank this video sponsor, The Motley Fool. Check out fool.com/ASYM for the top 10 stocks to buy right now. And let's start with the release. I'm going to go to the SEC filing because that's going to get to some of the details of what GM announced. But the press release at least gives us a high-level look at what's going on. This is the release this morning. GM reinstates 2023 earnings guidance. That's really sounds like they're going to announce the same guidance that they had previously. That's not the case. So I'll get into that, but I just want to highlight that right away. And then announces a $10 billion accelerated share repurchase program and 33% dividend increase starting in 2024. There's a lot of things going on there, so let's take these one by one. The guidance is updated. They pulled guidance last quarter during their conference call because at that time, the UAW strike was still going on. So we didn't know quite what the impact was going to be on production in 2023 and on costs as well. So if you don't know exactly what the business is going to look like, it makes sense to pull guidance. So some of the details here are net income are expected to be $9.1 billion, which is lower than the 9.3. So a couple of the details here that I think are important. Net income expected to be 9.1 billion to 9.7 billion compared to previous outlook of 9.3 to 10.7 billion dollars. That means that as I'm recording early on Wednesday morning, the stock is trading for 4.6 times net income. This is before any of the buybacks. EBIT adjusted 11.7 billion to 12.7 billion. That's down slightly from 12 to 14, which is their previous range. But this is the big one. Adjusted automotive free cash flow, $10.5 billion to $11.5 billion compared to previous guidance of $7 to $9 billion. This is partly from some of the pullback in capital expenses that the company announced earlier this year, but this is also an indication that prices are remaining really high for vehicles and margins are going to be really strong. So I think this is generally a very positive outlook for General Motors, and especially when you consider that this includes the costs related to the UAW strike and the impact on production there. The share repurchase program, that's the other piece to go through. And this is the segment that talks about that. $10 billion is going to be acquired, and that will be completed by the end of the year. But there is a super accelerated segment, and that is $6.8 billion worth of common stock, which will be executed immediately. Now, that immediately has a little bit of a caveat. I'll get to that in a second. That's really by the end of the week. But that is a very, very aggressive buyback plan. And one of the reasons they would do that is the stock is trading for such a low price to earnings multiple. Now, on top of that buyback program, there's a couple of other changes to the company's financing. They are canceling a $6 billion revolving credit facility it entered into in October, and it entered into a new 1-year, $3 billion credit facility with the same banks that are doing the buyback program. And even after this buyback, there's going to be $1.4 billion of capacity remaining under the existing share repurchase program. Now, a few pieces of detail are really needed in this. And for that, we go to the SEC filing that was filed this morning. Pursuant to the accelerated share repurchase agreement, the company will advance $10 billion to counterparties on December 1st. That is this Friday, and will immediately receive and retire an initial delivery of shares of the company's stock worth $6.8 billion. In other words, GM is going to give $10 billion to the banks listed above. And then on Friday, $6.8 billion worth of stock is going to be delivered to the company. So this buyback is going to be so accelerated that in the next 48 hours, GM is going to retire about 17% of the company outstanding. The remaining repurchase, which would be another $3.2 billion of shares, is going to be repurchased by the end of this year. And you can see that at the bottom here, no later than fourth quarter of 2024. So even that is a very accelerated share repurchase program, but the initial $6.8 billion is insanely quick because that's going to happen by the end of the week. The other announcement was the dividend increase that will begin in 2024. Not a huge dividend, but increasing that by 3 cents or 33% to 12 cents per share. The dividend yield for GM was only a little over 1%. So that's not a huge impact on the dividend yield, but a very big increase. We're going to be pushing closer to 2% after you account for the dividend increase and then the share repurchases. So a lot of big changes for General Motors, and I think there's a number of takeaways for us as investors. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I know it's very popular on the internet to talk about how these legacy automakers are dying businesses because electric vehicles are growing. Companies like Tesla and Rivian are much, much more popular, both from an investment standpoint and also for customers. It's much more fun to talk about those companies than it is to talk about a Chevy Tahoe or a Cadillac Escalade. But at the end of the day, where the money is being made today is in those big SUVs. And that is what General Motors is really focused on, is the cash flow that they're generating from making big trucks and SUVs. That is a segment of the market that is not being answered by the electric vehicle business. Yes, Rivian has the R1S vehicle, but that R1S is comparable in price to a Tahoe. And if you have sat in both of those vehicles, they are not at all the same size. So if you're someone looking for a 7-seat vehicle to fit a family or to fit sports gear, that is not what Rivian is answering with that vehicle. That is exactly what General Motors is answering with Tahoes, Suburbans, Escalades, vehicles like that. And that's where they are making a ton of money right now. That's why we're seeing this net income number be as positive as it is, why cash flow is as positive as it is. And if you think about where money is being invested for the future, where supply is increasing, it's going into primarily electric vehicles. That's why we're seeing Tesla having to reduce prices to move the amount of vehicles that it's producing, because it was planning to increase production by 50%. When you increase production that quickly, if demand isn't growing at 50% or more, the only way to spur more demand is by lowering your prices. That is exactly what we're seeing Tesla do. We're seeing Rivian have to introduce things like leasing. We're seeing Lucid run into financial problems because they can't move vehicles that they're making. So as supply increases on the electric vehicle side, we're seeing supply stay relatively stagnant on the ICE side, or the internal combustion engine side of the market. And what we have seen play out is that there is plenty of buyers. There is plenty of demand for those ICE vehicles. That's where there's more profitability. That's where margins are at least staying flat for the automakers. On the electric vehicle side, margins are falling. And then when you look at stock prices, stocks on the electric vehicle side are trading for many multiples times sales. Whereas on the ICE side, stocks like GM's trading for now 4 to 5 times earnings. This may not be the kind of growth business that a lot of investors like, but when it comes to cash flow, when it comes to returning money to shareholders by buying back stock, by increasing dividends, I think some of these older, maybe more stodgy companies like General Motors are going to be the place to be in the auto business. You're paying a very, very low multiple as investors. Companies like GM now are leading the way in buying back stock just in droves. Meanwhile, EV companies are fighting tooth and nail for every single customer that they can, lowering prices, losing money. And I think long-term, that's going to be a recipe for disaster for investors. You can't lose money in the manufacturing business long-term. This is a capital intensive business. You have to keep reinvesting that money in new capital, in new products. And you can't do that when you have to keep going back to the market over and over again. One by one, these companies are falling, the stocks are falling, and we're starting to see questions about whether they can be going concerns or businesses that can operate on their own long term. We are not facing the same challenges at General Motors. There's lots of cash flow coming from this business. There's lots of opportunity. GM is in no way facing bankruptcy, which I know is a popular topic, especially on YouTube videos. The opposite is true. This is a phenomenal business being extremely well run by Mary Barra, now buying back a huge percentage of the company. Nearly a quarter of the company might be bought back by the end of the year. And so the investors that own shares right now are just going to own a bigger chunk of General Motors in the future. And if we see any upside from a business like Cruise, which is something that I have talked a lot about in the past, then shareholders are just going to even own a bigger piece of that pie. So I love this move by General Motors. They have the cash to do this kind of buyback. They have the business that's generating cash flow and net income. And I think given the fact that a lot of the investment is going into electric vehicles right now, we're going to see these ICE vehicles just become a cash flow machine for the next decade or two. And that's something that I love about General Motors stock. But what do you think? Leave your comments in the comment section below. If you like this video, hit that like button and subscribe to Asymmetric Investing. Thanks for watching, everybody. I'll see you here next time.